Hey everyone, this is Hunter Satterfield, one of the partners here at Kane Waters and Associates, as well as the Chief Investment Officer. As always, today I am joined by Brad Sanders, the Managing Director of Tectonic Advisors. Unfortunately, today we don't have Brian Bortz, the head of our investment committee, as he's out of the office. I'm hoping somewhere great. This is your June market update. For the month of June, the S&P 500 was up 3.6%. Global stocks were up 1.9%. Domestic bonds were up 1.0%, and global bonds were just flat, up a touch at 0.1%. A very good month overall. And Brad, before I come to you to talk about, sort of what we've been seeing, I think it's interesting to see that again we have the S&P 500 outperforming, sort of the global stock market, and a lot of that is still, really dependent on those bigger names. So I'm sure we'll get into some of that. But today, here, we're recording on July 1st. So we are through the first half of the year, going towards the second half of the year. So I wanted to give our viewers and listeners sort of a mid-year outlook on what Tectonic is seeing for the second half of the year. First on equities, and then we'll come back secondly and talk about fixed income. So let's start with equities. So we've got the second half of the year. We've got, in all likelihood, higher for longer rates, is what the Fed has indicated. We've got the politics in Zoom as well with the election coming. Brad, what is Tectonic seeing or thinking of seeing here for the second half of the year in the equity markets?
Yeah, I think it's there's kind of an equal amount of good and bad that we're seeing. The bad part I would say is that this market is unbelievably concentrated. We have 75% of the all the money in the entire stock market, not just the S&P, is in the top 10% of names, really almost the top 8% now. We've only seen that like one other time, and it was right before the Great Depression after the Roaring Twenties. And I'm not saying we're going to have another depression, but I'm just saying that's the bogey. We so we have this market that's unbelievably concentrated in a handful of names, and those names are almost across the board pretty expensive on go forward rates. So in order for this to continue, you really need um, kind of some earnings magic from some of these companies in order to maintain these multiples going forward, or their net revenues just need to keep going up at the same pace they are, which I guess could certainly happen. I guess the good news though is that the broader markets are still pretty cheap. If you take those handful of companies out, in the second quarter, the Russell 1000, all over 100% of the return was five stocks. The average stock in that index was down 4%. So you can start looking elsewhere in the market and find value. Generally, when you get this concentrated and you're up here, like everything's really expensive, but that's not the case because we had a big chunk of the market in 2022 sell off and then really hasn't rebounded to the same extent as everything else in 23 and 24. So it's actually pretty easy to put money to work today in this environment, even given the concentration issues, because there's a lot of value outside of that. That's generally where our portfolios are invested. And I think over the course of the next 6 to 12 months, you're going to start to see capital reformation in the markets where you have maybe some money coming out of these bigger names and starting to find value elsewhere. Just as valuations get stretched and rates stay higher for longer, these stocks seem to buck the trend that we have higher interest rates now. And it's pretty apparent that even if the Fed starts cutting, we're still going to have meaningfully higher interest rates on a go forward basis, that we're probably not going back to zero. And a lot of these stocks are priced like we're still at 0% interest rate world. And so I would think we're going to have kind of a mixed back half of the year based on index level performance, if you want to look at it that way. But it very much like 99 2000, where, when the NASDAQ was correcting, you had value stocks up 20% in 2000, over 20%. The market set up the exact same way. So we just think if you're careful about what you own, you can be pretty excited here.
Yeah, and I think also, one of the things is if we are higher for longer, that we'll start to put a lot of stress on just companies that have bad earnings, like just bad companies. And so if you've got, this is one of the things, that we work with Tectonic on, Brad and your team, is just finding those high quality stocks and owning them on sort of a long term cycle. And I think that is the healthy way to approach this market. So I want to come back to you again here very quickly because you did obviously mention what I've already said as well, which is we are higher for longer. And even when we start to see some rate cuts, we will, in all likelihood, end up still at a much higher place than we were during the ZIRP period of zero interest rate policy. So, from a fixed income standpoint, what are you guys seeing as we look at the second half of the year for the fixed income markets?
Yeah, I think the bond market's kind of tipping its hand. We've had a pretty good drawdown in the 10-year yield. If you look at the 10-year Treasury yield, we're at about 4.4. We were sniffing around 5 there for quite a while. And I think the bond market is anticipating rate cuts early next year based on where the Fed funds futures are. What I think is pretty remarkable is that the credit quality has held up extremely well. I would expect it to have deteriorated a little bit here. And I think that's just an attestation that all these companies took advantage of the ZIRP period, termed out all their debt, really got their books pretty clean post financial crisis, and use those low interest rates to kind of get their house in order. Because when you go from 0 to 5, you would have expected to see a lot of maybe credit pressure, kind of across the board. High yield spreads are still pretty tight, and I just don't anticipate having a credit issue other than maybe a pocket in like commercial real estate or things like that. And so if you take kind of credit issues off the table, you could even say, maybe we have a mild recession or something. The bond market's healthy and it's cheap here. I think the moment the Fed cuts a quarter point, whether it be the December meeting or first quarter of next year, the bond market's going to price in several cuts. It's not going to price in one. And the duration component of the bond market's what's been missing for the last 18 going on 24 months. So once that duration component kicks in, I think you could see strong high single digit returns in your bond portfolios over a calendar year. And then going forward, the bond market, I think I've mentioned this on this call, it's doing the heavy lifting for the investors now. If you're putting new money into fixed income now, you're looking at entry yields on a 10-year of 4.4. You're expecting to get around 6% on a high quality credit portfolio. If you're in the private credit markets, you're looking at high single digits to low double digit returns. That is a much healthier, much more healthy environment and really helps our financial plans with Kane Waters. We had to do a lot of, we had to be really crafty there for about 6 years to get those mid-single digit returns on our bond portfolios that we experienced. We're beating the bond market, but it was really hard to do. Now you're getting that just in interest. It's a much better environment going forward for everybody that has a financial plan with a kind of a mid to high single digit growth target. That's going to be much easier to maintain going forward with this bond market.
Yeah, all great stuff as we go into the second half of the year. Thank you, Brad, and the entire Tectonic team for staying on top of everything. As always, folks, we will be back in front of you next month with the at the end of July with the July market update. Hope everybody had a wonderful July 4th, wonderful and safe July 4th, and we will be back with Brad and Brian here in a month. Thank you so much.